Well, I think the basic story is it's very difficult to do that right now. On one level, it's because things are changing consistently, right? So day to day, we just saw in Canada the change in their policy and their tax policy that changed the U.S. stance about their willingness to contribute or negotiate on trade and tariffs. So this is a very quickly and shifting environment, which means doing a model, you do a model today, you're going to have to change it tomorrow, and then the day after, and the day after. And so, what we're trying to do very much is try to get some idea about looking forward, what businesses are thinking about doing in terms of pricing, how they're going to respond to things. And the story there is that we really are starting to hear clear signs that they're expecting to raise prices, but how high and when that will happen is still quite unknown.
I mentioned to you off camera that we are still trying to see at the Bank of England and the NPR, which I read every time it comes out, the Monetary Policy Report, about the ramifications of Rachel Reeves' budget last autumn. We still don't know. The Bank of England still can't necessarily see it in the model as well. Given that that's already happened, something that necessarily hasn't happened yet, the One Big Beautiful Bill Act, the final trade levels or tariff levels, it would seem almost impossible for the Federal Reserve to factor in one way or t'other what's going to happen on the back of it.
Well, I think there are two things to think about. One is there already have been some tariffs that are put in place. Those are starting to run through, and we're starting to see some early signs that that is affecting inflation. The second thing, though, is that businesses are encountering, and they're really trying to work through an environment where their expectation about what tariffs would look like is actually quite different than where it's turned out. The initial numbers proposed are far greater than what we saw the last time. And so they're all trying to adjust and adapt to figure out, well, in this new world, like what is a strategy that's going to work moving forward?
Skewed because companies are being lambasted when they clearly cite tariff pressure for increasing prices. We saw it with an Amazon story a couple of months ago. If a company says, I'm putting prices up because of tariffs, the White House shoots them down very, very quickly as well. Is that making it more difficult to discern the actual effect of tariffs on businesses and consumption?
I don't think so. I actually think that the businesses are going to wait till they have some certainty. When they do, they're going to do the things that they need to do to satisfy their shareholders and their customers. Right now, what we see is really an environment where their cost basis, their cost structure is shifting in real time. But we don't know what it's ultimately going to shift to in final time so that they can set up a real strategy. But everyone we've talked to says, look, our costs are going to go up. If they go up as we expect, we're going to have to move prices because we don't have the extra margin that we can just afford to eat it.
A little bit of inflation is one thing, a price shock scenario is another. The latest data we had on the PCE was a 2.7% figure. Do you think if we get some increases here, it's going to be a price shock scenario? And if these were to be bigger increases, would it be transitory?
Well, I don't use that word. Okay. So I would say right now what we have is a situation where we're trying to figure out, everyone is trying to figure out what they're going to do. The textbook story for economics is if you do tariffs, it's a one-time shift, it happens quickly, everyone understands what's going on, and then the world goes back to how it was before. So you should look through that. What we are seeing today, though, is not just a one-time shift. It's actually something that's being stretched out over a much longer period of time. I think that runs the risk that people start to feel like inflation is always with them. This elevated level of inflation is always with them. And that then runs the risk that there might be some structural changes that businesses and consumers, for that matter, make in terms of how they respond and how they engage in the marketplace.
That is fascinating because you're now talking about a slightly longer window in terms of those expectations, which is relevant given we have a change potentially coming at the helm of the Fed. We just mentioned some of the personal attacks on Jay Powell. So at a time when he's trying to set policy, the dots are moving around, the market's trying to get a handle of what's going to be coming from monetary policy, not just here and now, but into the medium and to the long term. How detrimental is it then to have these attacks from Trump on Jay Powell, and also the suggestion of an early shadow?
So people are talking about the Fed all the time. Everyone has a view about where the Fed is and what they should do. That comes with the territory. What I think and focus much more on is what the data are telling us, what our business decision makers telling us, how are consumers responding to prices. And I actually think ultimately those will be the things that determine what the appropriate trajectory for policy looks like. And where prices and growth go.
Well, we're talking about the dots then. How much faith should the market put in those dots? Because I think as you're talking about policy maybe having to be reshaped, I think the market has that view about the dots. They're not really worth the paper they're written on at this stage. Would you agree?
Well, look, I think the dot plots give a good indication of the range of views of the committee. They are not a strategic decision document. Each of us sends in our dot. We don't know what anybody else has done. There's been no conversation. This is just sort of a picture of the full combination of outlooks that there are out there. It is not a decision-making document. What I think the dots do tell, though, is that there is a lot of different outlooks that are out there, a lot of different projections of where the economy is likely to go, and that manifests itself in different strategies. And you saw in the last dot plot, a bunch of folks were at 0, a bunch of folks were at 2, and it was interesting to see that split. And I think that really does speak to the uncertainty that's out there. It's a great amount of uncertainty, and it allows for us to have a wide range of different perspectives.
Speaking of different perspectives, over the last week or two, there's been a lot of focus on fresh comments from Michelle Bowman, one of your colleagues, putting July firmly on the table for a rate cut. Then you have Fed Chair Powell saying, we're comfortable waiting. It's too early to tell what these tariff effects are going to be. In your view, is July going to be too soon to act on rates? And is there broader momentum among Fed leaders for a July cut, or is she really an outlier here?
Well, let me say a couple of things. Every time I go into a meeting, all actions are possible, right? So I'm open to any possibility, and that's an important thing. I think for me right now, where I am is that I don't think that we're going to have enough clarity about the trajectory of the economy to really know for sure by July. We're only going to have one more measure of inflation. We're going to have a lot that's unknown about how other policies are impacting the labor market. And without that kind of clarity, I don't think it's going to be my view that it'll be appropriate to move in any direction at this point, but rather to wait.
When do you think you're going to have enough information?
Well, this is an interesting question. We've talked to a lot of businesses this is something we've clearly been asking, when do you know what you're going to do? And more are saying we're pushing that out because it's unclear how this is playing out. We may try some strategies to see how consumers respond. And so I'm hearing more say that they may not expect this whole thing to play out to where they're at their final strategy till even into 2026. So this could be a much more extended period than I think than many expect to see the full effects of all of this.
Is the dollar weakness complicating the situation with inflation? It's not something you've really had to contend with much in recent years. Is that having an impact?
It's not something that we've had to contend with a lot. I think for now, that's another thing that's in flux. And one of the questions is the weakness that we've seen in the dollar something that is going to sustain? Or will we revert back to our more normal pattern where that's a place of stability and we see great support in that marketplace? We just don't know right now.
Which is fascinating because when you combine that with actually relatively tame longer-term bond markets at the moment, we're getting a bit of a mixed picture. I think the dollar quarter today is down something in the region of 6.7% as well. So there is an indicator there that there is less appetite for US assets, and perhaps, but we're not seeing it in the 10-year really at the moment at 4.285. And we're not necessarily seeing that pressure in the 20-year at 4.8 and the 30-year at 4.8 as well. But people are near to levels where they're starting to get worried as well. Do you have concerns that actually the trickle out, and it's just a trickle out of US bond markets at the moment from international investors, could become something more sustainable if, as the non-partisan Congressional Budget Office believe, that actually the One Big Beautiful Act could actually, if it becomes an act, add $3.3 trillion to the US debt load?
Well, there can be pressures in financial markets, that's for sure. Our mandate is inflation and stable prices and maximum employment. And so those are the things that we want to focus on. I think the question that we're going to have, and the question I'm going to ask is, to what extent does the change that's happening in financial markets affect businesses' ability to get capital and do the things that they want to do at prices that allow them to keep stable prices?
Well, dare I say it, so the government's ability to raise capital at a price that isn't going to be punitive. And we've all seen the statistics that the US debt load is getting more than the defense budget at the moment.
Well, that can be a factor, but then the question then becomes, to what extent does that start to crowd out other activities? And we won't know that until we actually see what happens.
You mentioned the Fed's dual mandate, which is unique to the Federal Reserve. At this point, which do you think is more at risk, the stable pricing or the full employment mandate?
So, it's an interesting question. It's one that we're having a debate about in our building. To me right now, I think it's inflation. We have not been at our inflation target for almost 4 years. That is a long time, and we need to get that back down to target so that consumers have confidence that they understand where the economy is going to go. That said, the employment side has started to creep up, but when we talk to our businesses, what they're telling us right now, they don't have plans today to lay off a bunch of people. They think they can hold things stable, and that can allow us to keep our labor market as strong as it is today.
You mentioned consumer confidence, and we got some interesting soft data last week, the University of Michigan survey, which was closely watched earlier in the year for showing that inflation expectations had surged. This time round, households are feeling more optimistic in June. So my question is, there's been this big gap between weak soft data and strong hard data. We're all expecting the hard data to weaken, but is there a chance actually that sentiment data is just not very reliable these days, and actually we could see the hard data hold up and sentiment begin to improve from here?
Well, in the U.S., we've actually seen sentiment diverge from activity for quite some time. Through the whole pandemic, consumer confidence and views of the economy were quite negative, but consumers continued to spend. That was kind of anomalous. Now, one thing that I will say is that we've heard in Atlanta a change in sentiment from business leaders, basically saying, we think the likelihood that the doomsday outcome of all of this trade policy has reduced considerably. So there has been some optimism that's occurred, but we really don't know where this is going to land. I think with the consumers, one of the things that will be quite interesting is the consumers going into the last the last tariff effort, had not seen inflation. Today, they have now gone through several years of inflation, so it's unclear whether their response to any increase in prices will be quite the same. That'll be something that I'm looking at quite closely, because to the extent that the consumer pushes back or pulls back from the economy, that could have implications for both sides of our mandate.
Just finally, can I ask you about the impact on the terminal rate and the neutral rate? Because this is something that central banks just seem to be reshaping constantly. I've seen it from the ECB perspective when I've spoken to the governing council members. Where do you think you end up on the terminal rate eventually? And where do you think the neutral, and how much of that is shuffling around thanks to tariffs, geopolitics, BBB, and borrowing costs, everything else that we've been discussing?
Well, this is quite a complicated question. It's probably a whole show you could do on just the neutral rate alone.
30 seconds.
Here's what I would say. To me, I'm still looking at it somewhere in the mid-threes, but there's a lot moving, and with all the changes in policy, with the introduction of AI and other things that affect productivity, we're going to be doing a lot of study on this for many months and many years to come.